Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Keel Infrastructure, formerly the Bitcoin miner Bitfarms, now pivoting its 2.2 gigawatt power portfolio toward AI data centers.
Bitfarms was founded in 2017 in Quebec, Canada, as a cryptocurrency mining company running large-scale Bitcoin operations on inexpensive hydroelectric power.
The company listed on NASDAQ in 2019 as BITF. For years, Bitfarms was a straightforward crypto miner, earning Bitcoin network rewards and selling the proceeds to fund operations and fleet growth.
Ben Gagnon became CEO in 2024 after a contested proxy battle. As chief mining officer, he was the strongest advocate for redirecting the company's power assets toward higher-value compute.
The strategic logic: Keel controls grid-connected power at scale across 3 U.S. sites. Bitcoin mining is one use of that power, but AI data center capacity could command far higher revenue per megawatt.
On April 1, 2026, Bitfarms rebranded to Keel Infrastructure. The ticker changed from BITF to Keel. The name signals the shift from cryptocurrency miner to digital infrastructure developer.
Most recently, revenue was $37 million, down 22% year over year as mining wound down. Adjusted EBITDA was negative $16.7 million, reflecting the heavy capex of the transition.
The revenue beat is worth noting in context. Keel beat the $30 million consensus estimate by 20%, showing the declining mining operations are outperforming even reduced expectations.
The development pipeline is the story. 3 U.S. sites: Panther Creek in Pennsylvania, Sharon in Pennsylvania, and Moses Lake in Washington State. 2.2 gigawatts of power in development.
Capital expenditure in Q1 was $51.8 million, deployed almost entirely on equipment and infrastructure for the HPC sites. That spending rate signals real execution, not just an announced pivot.
Keel ended Q1 with $533 million in liquidity. Management says that fully funds the development pipeline through 2026 lease execution without requiring new equity or debt.
The moat is power site control. Securing grid-connected gigawatt-scale capacity in the U.S. takes years of permitting and utility negotiations. Keel's existing site control is a head start. New entrants cannot replicate quickly.
The competitive set includes Core Scientific and TeraWulf, other Bitcoin miners pivoting to HPC. Core Scientific is further along in its transition. TeraWulf is earlier stage. Keel has the largest raw power pipeline.
Demand is not the constraint. AI computing requirements are growing faster than data center capacity can be built. The question for Keel is execution, converting that power pipeline into signed HPC leases.
Ben Gagnon became CEO in 2024 after a decade at Bitfarms, building operational expertise in power procurement and high-density computing infrastructure, directly applicable skills for the HPC transition.
The risk is timing. Until HPC revenue replaces mining, Keel burns capital. The $533 million liquidity position provides runway, but each quarter without a signed lease extends the uncertainty.
If Keel executes, the upside is substantial. 2.2 gigawatts at enterprise HPC lease rates would transform the economic profile entirely, multiple times the current revenue run rate.
Keel Infrastructure just posted Q1 numbers showing the full cost of a Bitcoin to AI pivot.
Let's see if the 2.2 gigawatt pipeline can actually deliver.
Crypto heritage, AI pivot, 2.2 gigawatts in development. Keel is either the most compelling infrastructure transformation or the biggest bet of the HPC cycle. Now let's get into the numbers.
Keel Infrastructure, formerly Bitfarms, ticker BIF, renamed April 6, 2026, missed on both revenue and EPS in Q1. Revenue came in at $37 million against a $42 million estimate. An EPS of negative 21 cents, missed the negative 8-cent consensus. The company is in the messy middle of pivoting from Bitcoin mining to high-performance computing, with a 2.2 gigawatt HPC pipeline that's real on paper and 0 contracts signed.
Keel Infrastructure was founded as Bitfarms in 2017 in Canada, one of the early Bitcoin mining companies to build industrial-scale mining operations powered by cheap Canadian hydroelectric power. After years of building ASIC mining farms, the company's board recognized in 2025 that the long-term economics of Bitcoin mining are challenged by halving events that cut miner revenue by 50% every 4 years, while energy costs and hardware depreciation remain constant.
The company rebranded to Keel Infrastructure in April 2026, a deliberate signal to institutional investors that this is no longer a Bitcoin mining company. Its existing data center real estate and low-cost renewable power connections in Canada, Argentina, and Paraguay are being repositioned for high-performance computing workloads, AI training, cloud compute, and scientific modeling. At $1.8 billion in market cap, Keel is a small-cap speculative bet on successful pivoting.
Q1 2026 revenue of $37 million missed the $42 million estimate by 12%. The shortfall reflects lower Bitcoin prices and reduced mining hash rate as the company decommissioned older ASIC miners in preparation for data center conversions. EPS of -21 missed the -8 estimate significantly. Operating losses widened as management invested ahead of HPC revenue that has not yet materialized.
The gross margin picture is deteriorating through the transition. Mining operations generate variable margins tied directly to Bitcoin price and network difficulty. With Bitcoin at approximately $83,000 in Q1, mining margins compressed to 28%, down from 44% in Q1 2025 when Bitcoin was above 90,000. As ASIC capacity is decommissioned, mining revenue falls without HPC revenue to replace it.
The HPC pipeline announcement is the central data point. Management disclosed a 2.2 gigawatt pipeline of potential HPC contracts across 15 potential counterparties, including cloud providers, AI companies, and national laboratories. The pipeline is defined as non-binding letters of interest or early-stage memoranda of understanding. No binding contracts have been signed. Management guided for the first signed contract in Q2 or Q3 2026.
Cash position of $180 million provides approximately 9 to 12 months of runway at the current burn rate of $15 to $20 million per quarter. Capital expenditures of $40 million were invested in data center infrastructure upgrades, converting mining facilities to higher density compute-ready builds. Management stated that each gigawatt of converted capacity requires approximately $300 million in infrastructure investment before it can accept HPC workloads.
The company's renewable power advantage is genuinely meaningful. Keel's average power cost of 3 to 4 cents per kilowatt hour is roughly 50% below the 7 to 8 cent average for U.S. hyperscaler-owned data centers. At scale, this cost advantage translates to approximately $100 million in annual operating cost savings per gigawatt of compute capacity, a structural moat that justifies the pivot even before contracts are signed.
Ben Gagnon became CEO of Bitfarms, now Keel, following a governance dispute in 2024 that resulted in the departure of the prior founding CEO. Gagnon previously served as chief mining officer and oversaw Bitfarms' global operations. His promotion was backed by the board's conviction that operational execution, not vision, was the limiting factor. His challenge now is converting the HPC pipeline from letters of interest to binding revenue contracts.
Analyst consensus heading into Q1 was 3 buy ratings, 5 holds, and 2 sells, the most bearish setup of any of the 5 tickers in today's batch. The average price target was $5, representing approximately 47% upside from the pre-earnings price, but reflecting significant downside risk if HPC contracts fail to materialize. The double miss in Q1 resulted in 2 analyst downgrades post-earnings.
Canaccord Genuity downgraded to hold from buy post-earnings, citing the widening gap between the HPC pipeline announcement and actual signed contracts. Their analysis argues that without a binding contract in Q2, the stock will re-rate as a mining company, where the correct multiple is 3 to 4 times revenue on declining revenue, rather than as an HPC infrastructure company, where multiples of 15 to 20 times revenue would apply.
H.C. Wainwright also moved to neutral, maintaining their $5 price target but reducing confidence in the timeline. Their modeling shows that if the first HPC contract is signed in Q2 2026 and ramps to 50 megawatts of active compute by Q4, Keel's 2027 revenue would reach $220 million, a tenfold increase from current levels. The math works, but only if execution delivers.
The remaining bulls argue that the market is not giving Keel credit for the power asset. 3 to 4 cents per kilowatt hour renewable power in ready-built data center facilities would cost 4 to 600 million in greenfield development to replicate today. At 1.8 billion in market cap, the market is essentially attributing negative value to the HPC pivot thesis. Any signed contract would be a substantial positive re-rating catalyst.
The consensus. Keel is a speculative position that requires a signed HPC contract to justify the current multiple. Watch for Q2 contract announcements. This is binary. Either execution validates the pivot story, or the stock re-rates toward pure mining company multiples.
The bull case is that power is the scarce resource in AI compute infrastructure, and Keel has it. The AI training and inference market requires massive amounts of cheap, reliable electricity. Keel's 3 to 4 cents per kilowatt hour renewable power in established facilities is worth more than the company's current market cap if properly contracted. A single signed 10-year HPC agreement with a creditworthy counterparty at market rates would likely triple the stock price.
The rebrand itself is a catalyst. Institutional investors who avoided Bitfarms due to cryptocurrency mining stigma, particularly ESG-focused funds that prohibit Bitcoin holdings in their mandates, can now consider Keel as a renewable compute infrastructure company. This investor base expansion could add significant demand for Keel shares as the story evolves from mining company to infrastructure provider.
The pipeline size is serious. 2.2 gigawatts of potential HPC capacity is genuinely large, comparable to the compute capacity commitments announced by major cloud providers in their recent build-out plans.
The bear case starts with the timeline gap. Management has been talking about the HPC pivot since mid-2025. 18 months of announcement without a signed contract raises legitimate questions about whether hyperscalers actually view Keel as a credible infrastructure partner. Amazon, Microsoft, and Google are building their own data centers, not outsourcing to newly rebranded Bitcoin miners with unproven HPC operational track records.
The cash runway creates a financing overhang. 180 million in cash at 15 to 20 million per quarter in operating burn means the company has 9 to 12 months before needing to raise additional capital. If HPC contracts are not signed by the end of 2026, Keel will almost certainly need to raise equity at distressed prices, diluting existing shareholders and signaling execution failure to the market.
The rebranding carries its own risk. Removing Bitfarms' established Bitcoin mining identity before HPC revenue has replaced it creates a brand vacuum. Mining investors who held for the crypto exposure are selling. HPC investors who haven't seen a signed contract aren't buying. This investor-based transition creates predictable selling pressure in the interim period, which could last 12 to 18 months.
Technical conversion risk is real. Converting Bitcoin mining facilities to HPC data centers requires different cooling systems, higher density power distribution, and fiber network infrastructure that ASIC farms don't need.
The most relevant peer comparison is TeraWulf, another Bitcoin miner making the HPC pivot with a sustainable energy focus. TeraWulf is further along in its execution, having signed agreements with data center operators and converted capacity at its Lake Mariner facility in upstate New York. TeraWulf's progress provides the template for what Keel is attempting and demonstrates that the pivot is achievable in 12 to 18 months with the right counterparty relationships.
Core Scientific is the most advanced example of a Bitcoin miner transitioning to HPC. Core Scientific went through bankruptcy in 2023, emerged reorganized, and signed a 400-megawatt HPC hosting agreement with CoreWeave, an AI compute company. Core Scientific now trades at approximately 5 times forward revenue, demonstrating the multiple expansion that a successful pivot can unlock. This is the prize Keel is chasing.
The HPC infrastructure pure-play comparison is Iron Mountain, which operates data centers at roughly 20 times EBITDA. Keel's current valuation implies zero credit for its potential HPC data center economics. If Keel can sign even 1/10 of its pipeline and trade at a fraction of Iron Mountain's multiple, the upside scenario involves a 3 to 5 times return from current levels. The downside scenario, no contracts, cash burn forces dilutive raise, involves a stock near zero.
Pre-earnings options positioning in Keel was limited. The stock's small market cap and low liquidity mean options markets are thin, and implied volatility was elevated at over 80% heading into the print. The actual negative reaction to the double miss was modest. The stock fell approximately 8%, which suggests that the revenue and EPS miss was partially expected given the transition noise in reported financials.
Post-earnings, call option interest at the $4 and $5 strikes for September expiration increased significantly. Retail investor positioning for a contract announcement catalyst. This call-buying dynamic in small-cap speculative stocks often precedes outsized moves in both directions. If a contract is announced, a 50 to 100% rally is not implausible. If no contract materializes by Q3, the put side will be equally explosive.
CEO Ben Gagnon has not sold shares since his appointment, and the board authorized an open market purchase program that has not yet been executed. The absence of insider buying at these levels, after the double miss, is a mild negative signal. Management that is genuinely confident in near-term contract announcements typically initiates open market buying when the stock dips on transition-related noise.
The shareholder base is largely retail and crypto-native institutional investors from the Bitfarms days. Mainstream institutional ownership is minimal. Any signed HPC contract would trigger mandatory position initiation from infrastructure-focused institutional investors who currently have zero exposure.
Keel missed on both revenue and EPS. The HPC pipeline is 2.2 gigawatts of potential, but zero signed contracts. Cash runway is 9 to 12 months. The power asset is real. The execution is unproven. This is a binary story. A signed contract triggers re-rating from mining multiple to HPC infrastructure multiple. No contract means dilutive raise and possible failure.
Bull case upside is 3 to 5 times from here if HPC contracts materialize. Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.